Have you ever been in a conversation and wondered, what the hell is this Forex thing they're all talking about? And no, it's not for your ex. It's not about that ex, let it go. Come on. Where were we? Right, the conversation. What is this Forex thing that your friend from high school is into now? Suddenly, he's driving, cough, cough, renting Lamborghinis, taking mysterious trips to the Bahamas, and starting a podcast. Yeah, he might be exaggerating, cough, cough, selling some smoke, but you can actually make money in Forex. It's just not as easy as that Become Rich in 6 Weeks course your friend is trying to sell you. So, how does one actually make money in Forex without selling their soul or their grandma's secret cookie recipe? Well, it all starts with understanding the basics. Forex stands for foreign exchange market, and it involves buying one currency while selling another. Think of it like a stock market for currencies. You notice a currency is undervalued, so you buy it, hoping its value will increase. When it does, you sell it for a profit. That's Forex trading. Strategically buying and selling currencies to capitalize on value fluctuations. Now, here's the kicker. The value of these currencies changes based on supply and demand, economic news, and even geopolitical events. To navigate this fluctuating market, traders rely on a mix of technical analysis, which involves studying charts and patterns, and fundamental analysis, which focuses on economic indicators and news events. Successful Forex trading requires discipline, patience, and a solid understanding of risk management. It's not about making impulsive decisions based on gut feelings. Instead, it's about crafting a well-thought-out strategy and sticking to it. In the world of Forex trading, currencies are traded in pairs. In a Forex pair, there are two parts, the base currency and the quoted currency. For example, in the euro dollar, the base currency is the euro, and the quoted currency is the US dollar. When trading Forex, you're determining how much of the quoted currency, US dollars, is needed to purchase 1 unit of the base currency, euros. There are 7 major pairs, and knowing the major pairs is vital for traders. Each pair has its own traits and is affected by different factors, making them key tools for trading. Euro, US dollar. This is the most traded pair globally. The euro, representing the Eurozone, is paired with the US dollar, serving as a gauge of global economic health. It's popular among traders due to its tight spreads and relatively low volatility. US dollar. Japanese yen. This pair is greatly affected by the interest rate differences between the US and Japan. The yen is often seen as a safe haven currency, making this pair important during economic uncertainty. Think of the dollar-yen as the Forex link between the Western and Eastern worlds. Its high liquidity makes it one of the most traded pairs. British pound, US dollar, known as cable. This pair is famous for its volatility and large price swings. The British pound's value is significantly influenced by economic and political events in the UK, drawing attention during uncertain times like Brexit. US dollar, Swiss franc, referred to as the Swissy. This pair is another major player. The Swiss franc is also seen as a safe haven currency, making this pair a go-to during market turmoil. Switzerland's economic stability and neutrality enhance the franc's appeal. Australian dollar, US dollar, also known as the Aussie. This pair is affected by commodity prices, especially gold and iron ore, due to Australia's export-driven economy. Traders often use this pair to capitalize on commodity price changes, and it can be more volatile than other major pairs. US dollar, Canadian dollar, called the loonie. This pair is closely linked to oil prices, given Canada's role as a major oil exporter. Fluctuations in oil prices can significantly impact this pair, making it a focus for commodity traders. New Zealand dollar, US dollar. This pair is influenced by New Zealand's agricultural exports, particularly dairy products. Like the Aussie, it is sensitive to commodity price changes and is often traded during the Asian session. While these 7 pairs are widely recognized as major Forex pairs, some traders and analysts consider only the first 4, Euro US dollar Japanese, yen, British pound US dollar, and US dollar Swiss franc, as the core majors due to their trading volume dominance. The remaining 3, Australian dollar US dollar Canadian dollar, and New Zealand dollar US dollar, are often categorized as commodity pairs because of their economy's reliance on natural resources.
Cough, cough, I beg your pardon. There are some other pairs in the Forex world. These pairs are like the supporting actors, much like myself, C3PO, who don't get as much spotlight as the majors, but still play crucial roles, don't we? They are called minor pairs. These pairs don't include the US dollar, which makes them a bit more unpredictable and exciting for traders seeking opportunities beyond the mainstream. Think of pairs like EUR GBP, EUR AUD, or GBP JPY. They often come with wider spreads and can be influenced by regional economic factors, political events, or even market sentiment. Trading minor pairs requires a keen eye and a solid strategy, as their movements can be less predictable but potentially rewarding for those who know how to navigate the twists and turns of the Forex stage. So, if you're ready to step off the beaten path, minor pairs might just be your ticket to the next big trade. Also, did you know that—
Enough of minor characters. Let's continue. In Forex, market fluctuations are calculated by pips. A pip, short for percentage in point, is the smallest price movement in the Forex market. It's a standardized unit that represents a change in value between two currencies. Typically, a pip is the fourth decimal place in most currency pairs, except for pairs involving the Japanese yen, where it's the second decimal place. If the euro-dollar moves from 1.04421 to 1.04431, that's a 1 pip movement. Pips are crucial for traders as they help measure price movements and calculate potential profits or losses. When talking about Forex, you will always hear the word spread. The spread in Forex trading is the difference between the bid price and the ask price of a currency pair. The bid price is what buyers are willing to pay, while the ask price is what sellers are asking for. This difference is one of the ways brokers make money. For example, if the euro-dollar has a bid price of 1.03985 and an ask price of 1.04002, the spread is 1.7 pips. A narrower spread indicates a more liquid market, while a wider spread can suggest less liquidity or higher volatility. Understanding spreads is essential for traders to manage costs and make informed trading decisions. In the world of Forex, timing is everything. The market operates 24 hours a day, 5 days a week, thanks to the different time zones across the globe. But not all hours are created equal. Let's dive into the Forex sessions and the best times to trade each pair. Sydney session. Kicking off the trading week, the Sydney session is relatively quiet. It's a good time for beginners to dip their toes in the water. The Australian dollar, AUD, and New Zealand dollar, NZD, are the stars here, influenced by local economic news. Tokyo session. As the Sydney session winds down, Tokyo takes the stage. The Japanese yen, JPY, becomes the focus. This session is known for its liquidity and can be a good time to trade pairs like USD JPY and EUR JPY. London session. The heavyweight of Forex sessions, London sees the highest trading volume. Major pairs like EUR, USD, GBP USD, and USD CHF are highly active. The overlap with the Tokyo session adds extra liquidity, making it a prime time for trading. New York session. As London winds down, New York picks up the baton. The US dollar is in the spotlight, with pairs like EUR USD, GBP USD, USD CAD seeing significant action. The overlap with the London session offers some of the most volatile and profitable trading opportunities. Remember, while timing can enhance your trading strategy, it's not just about catching the right session. It's about understanding the market dynamics and being ready to adapt. And there you have it, folks. You've now got the lowdown on Forex, the magical world where currencies dance to the unpredictable tunes of economic news and geopolitical drama. Forex, the biggest and most liquid financial market globally, with an average daily turnover of 7.5 trillion US dollars. Who knew trading could be so much like a Star Wars saga, right? Remember, while your high school buddy might be flaunting his rented Lambo and mysterious Bahamas trips, real success in Forex isn't about quick riches. It's about patience, strategy, and maybe a little less drama than your friend's podcast. So next time someone brings up Forex at a party, you can confidently join the conversation. Just don't be that person who tries to sell a get-rich-quick course. The force won't be with you. Happy trading, and may your currency pairs always be in your favor.